Welcome back, everybody. Believe it or not, the oldest stock in my portfolio is also one where I've never actually done a dedicated video for, and that stock is McDonald's. Being that I just cut Starbucks from my portfolio with their very concerning earnings report and outlook, and McDonald's is already down 10% year to date, while the S&P 500 is up almost 10%, there's a legitimate question of whether or not McDonald's is at risk for the same kind of issues. So in this video, we're going to break down McDonald's business, how they're performing from a fundamentals perspective, as well as their most recent earnings, and talk about what the outlook is for the company going forward. So let's get started. McDonald's is a company that really needs no introduction. Whether you love them or hate them or don't really care, you know who they are. And I've talked about it many times that I have a personal connection with the company. And I just realized that I am looking a little rough today, so I apologize that that's the view that you get. I'm looking like that year-to-date McDonald's chart, pretty roughed up. But I have great memories with McDonald's way back with my grandpa, with my parents, and now even with my daughter. And it's one of the reasons why I don't really panic anytime it's not performing well. Because I love McDonald's as a company, and I'm okay with an emotional component to one of the stocks in my portfolio because, we don't have to be robots about this stuff. But what people don't realize is that McDonald's isn't really a burger company. They're more like a real estate company that also owns and licenses one of the most valuable franchises in the world. And let me explain what I mean by that. Because this is how a store or restaurant usually works. In order to open the store, you have to buy or lease the real estate, you have to construct the building, and you have to buy all the equipment and decor. And then when it comes to running the restaurant, you run the daily operations, you manage the revenues and expenses, and then whatever's left over is your profit. Pretty simple, right? Well, with McDonald's, it's slightly different. In their conventional franchise model, to open the store, McDonald's either buys or secures a long-term lease on the real estate in the building. The franchisee invests the money to get the equipment and the decor, and then when it comes to running the store, the franchisee runs all the day-to-day operations, but they have to pay McDonald's rent for the real estate and the building, as well as franchise fees and royalties as a percentage of sales. Oh, and when the store orders from suppliers, that also goes through McDonald's corporate. And just to put this into perspective, while cash flow and expenses and all that can vary from month to month, rent and royalties are going to be paid no matter what. That's going to come out first out of any revenue that they make, which leads to better predictability of revenues and lower overall risk for McDonald's, the corporation. And you might be wondering, why would any franchisee actually do this then? Well, that's because McDonald's franchises are wildly successful, averaging $3.4 million in sales per location, which ranks about 6th. But the crazy part about that is they're doing it with over 13,000 locations in the U.S., which is much higher than any of the top 5, which include Chick-fil-A at less than 3,000 locations, Raising Cane's at less than 600 locations, Krispy Kreme at less than 400 locations, Shake Shack at less than 300 locations, and then my beloved Texas Whataburger at less than 900 locations. So as you can see, McDonald's have proven that they can scale locations and still make a lot of money at each one. So of course, that's why franchisees do it. You get access to one of the most valuable brands in the world, premium retail real estate, and the basic guarantee almost that you're going to be successful. Now, while the conventional franchise model, like we just talked about, makes up about 55% of their restaurants, McDonald's has other franchise models, like the developmental license and foreign affiliated, where they just take royalties and don't own the real estate or building. And those make up about 40% of their stores. And then, of course, they still have about 5% of their stores that are fully owned and operated by McDonald's themselves. But this number has been dropping, and that's been a major part of their corporate strategy over the past decade. And you can see that in 2013, they had about 80% of their stores franchised, and now in 2024, it's 95%. And why that matters is because the margin on a franchise restaurant is significantly better than one that they operate themselves. The company-operated restaurants had a 16% profit margin in 2023, while the franchise restaurants had a whopping 84% profit margin. So the push to a mostly franchise model makes a lot of sense, because what that means for the company is they've gotten to be a lot more profitable overall. And you can see the trend in gross profit margin as well as free cash flow margin over the past decade, going from a gross profit margin of about 39% and a free cash flow margin of about 15% in 2014 to a gross profit margin of about 57% and a free cash flow margin of 25% in 2024, which is a substantial improvement in a decade for a company of McDonald's size. And that's also why you can't really judge McDonald's on revenue growth by itself. And let me show you what I mean. When you look at McDonald's 10-year revenue, revenue, the first thing that jumps out is, wow, 6 out of the 10 years have declining revenue growth. But you have to understand that as they've aggressively moved to the franchise model, the revenues have actually gone down. And that's because the company-operated stores generate a lot of revenue because you're including every Happy Meal, every breakfast sandwich, and every coffee that's bought at the store in your top line. But then once those stores are moved over to be franchised, all of a sudden the revenue goes down because revenue is now just rent and royalties and not every transaction that the store makes. And you can see this change over time. In 2013, sales by company-operated restaurants was $18.9 billion versus $9.2 billion for franchises for a total revenue of $28 billion. In 2023, sales by company-operated restaurants was down to $9.7 billion versus the $15.4 billion for franchises for a total revenue of $25.5 billion. So on the surface, you might be like, wow, McDonald's sucks. In 10 years, the revenue's actually gone down. There's been no growth. But if you look at actual operating income, it's a much different story. In 2013, the operating income was $8.8 billion on $28 billion in sales, and in 2023, operating income was $11.6 billion on $25.5 billion in sales. So that's why just looking at revenue for McDonald's doesn't really work, as they've transitioned to being mostly franchise restaurants, which technically means less revenue, but more overall profit. So that's why when people assume that McDonald's is just some burger company, they're wrong, because they're actually a premium retail real estate company that also owns and licenses one of the most valuable brands in the entire world. So, that's probably a lot more about McDonald's than you ever wanted to know, but I love it, or I'm loving it. So let's take a look at how McDonald's has been performing recently and how it compares. So just to recap, generally what they report each quarter are comparable sales, which is same-store sales growth for stores open longer than a year, and this is for all stores whether they're franchised or company-operated, as well as system-wide sales, which is total store sales regardless of how long the store was open. And then system-wide sales to loyalty members is sales to members of McDonald's loyalty program. And I look at these as app-related sales, even though they can be inside the store as well, but they're still interacting with their loyalty program within the McDonald's app. Now, consolidated revenue growth is the actual revenue growth of McDonald's as a corporation, not every restaurant. Operating income growth, again, is obviously the operating income of McDonald's corporate, and then, of course, earnings per share, which we know what that is. And as I was going through this for this video, I actually realized I needed to update my list of what I was monitoring for McDonald's to include some of these things that I had left off. So what I called revenue growth before really should be store sales growth. So I'm updating that and making sure that global comparable sales is included. And then I'm adding a company growth header with consolidated revenue growth and operating income growth, which tie directly back to McDonald's corporate. And then, of course, dividend growth obviously will stay the same. Okay, so let's see how McDonald's did for 2023. They had global comparable sales growth of 9%, system-wide sales of 10%, and system-wide sales to loyalty members increased by 45%. Consolidated revenue growth was up 10%, consolidated operating income increased 24%, and earnings per share was up 39%. So really an amazing year for McDonald's last year, and overall for the year, the stock was up almost 15%, which is pretty respectable performance, but obviously lagged the S&P 500's 26% return, which on some level should be expected because McDonald's is more of a defensive stock. Like, it's not going to keep pace with the hotter trends of the market, and we really shouldn't expect it to. So now if we go to the first quarter of 2024, we can see that McDonald's had global comparable sales growth of 1.9%, system-wide sales of 3% growth, and system-wide sales to loyalty members actually decreased 20% year over year. Their consolidated revenue growth was up 5%, and their consolidated operating income increased 8%, with earnings per share up 9% year over year. So what this is telling us, obviously, is that sales have been slowing down. And even with their loyalty program, they had digital sales slowing, at least based on the year over year quarterly basis. For the trailing 12 months, they were down just 2% as opposed to 20%, but it's still something to watch. But even with all that, there were some positives in there, because while sales growth was definitely down, it was still positive growth. And because of their franchise business model, while store sales growth was slower, corporate revenues grew a respectable 5%, 10%, corporate operating income grew a respectable 8%, and earnings per share was still up 9%, which is pretty good, especially when we're in a so-called tough quarter for the consumer, because if we compare their performance to what Starbucks just released, Starbucks had comparable sales actually down 4%, their consolidated revenues were down 2%, and their earnings per share was down 14%. So the combination of McDonald's seeming to be a little bit more resilient than Starbucks, plus the fact that their business model helps them kind of handle the unpredictability of revenues a little bit better, to me was a big plus of McDonald's versus Starbucks just in terms of how they're put together. And then when you compared how the management teams reacted on their earnings call, it was a pretty stark difference. And I talked about the Starbucks one in my previous video, where basically they focused on increasing growth by meeting unmet demand, which was drive-through efficiencies, as well as potentially staying open later and incentivizing weekend traffic. And they talked about new innovative products to incentivize growth. And then lastly, they talked about reaching and communicating more value to their occasional customers. And how they plan to do that was in-app offers, which could be related to bundles or cheaper pricing. And then it was improving wait times and opening up the app to everyone. And look, those things may sound okay, but they sound more like a company looking to make incremental improvements, not one that just went from a 15 to 20% earnings per share guidance to a 0% earnings per share guidance in one quarter. And if we contrast that from the notes of the McDonald's call, you can see that the way they talked about it was much more direct. We must be laser focused on affordability, good entry-level price points available every day. It's imperative that we continue to keep affordability at the forefront for our customers. And then here, saying traffic is flat or declining even more than they expected, but affordability is where consumer expectations are heightened. And then just a little bit later, actual examples of the value that they provide. 90% of our system in the US is offering meal bundles for $4 or less. We have great digital offers out there. I just opened my app while I was waiting to jump on this answer, and we're offering right now a Big Mac for 29 cents when you buy a Big Mac, or you can get 30% off crispy. I mean, that is how you show and communicate value. Like, hey, we're talking right here. I just opened my app and look at the great offers I have on it. I mean, that's pretty well done. And that's way better than we're looking into the Toyota production efficiency system. I mean, come on, give me a break. And then right after that, more tangible plans to hit on affordability, saying we're showcasing a lot of value and value messaging locally with each store, but we're not showing that value message nationally. And we're going to do that going forward. So from my perspective, McDonald's conference call was just light years better. They focused on value, just like Starbucks did, but they did it in a different way. Affordability was the focus, not communicating their existing value. They had actual examples with prices of the value that they're already offering, saying they had opportunities to get that value message out there even better nationally, but that the value is there, and that they're going to continue to be laser focused on affordability since the consumer is getting hit hard. And then just Friday, there was a report that McDonald's was working on a $5 meal deal, specifically to help consumers who were struggling. And the stock popped about 2% just on that news. And to me, that's a management team that understands their customer and understands how to adapt to the situation. And just remember, this is the company that still had growth. It was just slowing. Because that was a company that still had a 9% increase in earnings per share, not the one with declining revenues, declining income, and declining earnings per share. So a couple of you asked me if I was concerned about McDonald's because of my concerns with Starbucks and the fact that I actually sold my Starbucks holding. The answer is no, I'm not. Now, obviously, I have a personal connection with McDonald's, so it's going to take a lot for me to sell that position, and I may never sell that position. But for me, their unique business model and their plan going forward give me confidence that they're going to figure it out and be okay. And I just didn't have that same feeling with Starbucks. So if I was rating McDonald's today based on my 3 criteria of business, operational performance, and valuation, from a business perspective, McDonald's is one of the most recognizable and valuable brands in the world. Their unique business model is a huge plus, and while growth and saturation is a concern for its size, they have some interesting things coming up with a large amount of new store openings, focus on digital sales, as well as Cosmix, which is going to be a direct competitor to Starbucks. So even with the recent slowing growth, I would still rate their business as good. Now, from an operational performance perspective, they have excellent margins and profitability as they've transitioned their business model to be 95% franchise. They've had respectable dividend growth at around 8% a year over the past 5 and are buying back shares as well. But they do carry a lot of debt. So from an operational performance perspective, I would probably rate them as okay. Now, from a valuation perspective, their price to earning and price to cash flow ratios are below their 5-year average. And if you look at their 10-year trend, it's starting to get down to a range that has historically been very attractive for McDonald's. Still, if you account for the macro challenges likely slowing growth in the near future, as well as interest rates being higher for a company holding a lot of debt, the lower multiple is probably justified, at least for now. So in terms of valuation, I would rate them as just okay. Now, in terms of if McDonald's is still a good stock or not, it's obviously going to depend on what your goals are and what type of companies you're looking for in your portfolio. Now, is McDonald's going to keep up with all the hot tech trends? No, obviously not. And it's probably going to struggle to keep up with the smaller market cap companies that are still growing at a high rate, like Texas Roadhouse, for example. But McDonald's, in my opinion, should continue to provide steady, above-average business performance and returns. And for my portfolio anyway, it helps to balance out the big tech and financials focus that really dominates my current portfolio. And even now, McDonald's is still my third largest holding, but I understand the role that it plays in my portfolio, and obviously I have a personal connection to it. Which again, some people are going to believe that we should make every decision with stocks to be very cold and calculated, and I just have a slightly different view. I think one of the fun parts about picking stocks is that we have the opportunity to attach ourselves to companies that we enjoy or that we admire, and that can be a really big motivating factor just as much as having really great returns or even beating the market can be. Because remember, the goal is to create financial security for yourself and your family. It's not to impress people on the internet. So whatever keeps you actually interested in building towards that goal is what actually matters. So what do you guys think about McDonald's and its future outlook? Let me know down in the comments below. Now, if you want to know the details about why I was concerned about Starbucks' most recent quarter and why I sold out of the position, you can watch that video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.